Thank you so much for joining us for this shipper update. I'm Zach Strickland here with our illustrious lead economist, Anthony Smith. Anthony, you're here to give us some insight on to some consumer durable goods expenditures?
Exactly right. So, Zach, we have Van Outbound Tender Volume Index here in the blue, and in the green, of course, we have our personal consumption expenditures, but for durable goods. So taking a step back from durable goods, looking at overall consumer spending, which is going to be PCE, overall, not just durable goods, we saw a 1% increase month to month. And so that's telling because, of course, we haven't had much stimulus coming through, and we're getting further and further away from that. The other thing that's also happening that we're going to touch on in just a moment here, prices. We're seeing less stimulus, more inflation, consumers still spending. And so we're seeing all of that still amount to consumers still being active throughout July. And so this is something that's going to really feed into, of course, freight volumes. That's something that really fed into freight volumes throughout 2020, kind of continued into 2021, and something that we really kind of anticipate to really persist going into the remainder of the year. There's been a lot of talk, of course, throughout 2021 when there's going to be a shift from services to, or goods to services. And right now, one of the reports I'm seeing is that consumers are really at a large, really anticipating one more big trip, one more hurrah before the summer's over. I think I've heard a lot of people pinpointing late August as one of those trips, and that's going to be one of those service spending pain points or pinpoints to really watch out for. But even with that, consumers are still in a relatively really good point right now, or place right now. We're looking at consumers that have good savings rates right now. We're seeing consumers that are still have pretty good credit card expenditures right now going on because that revolving credit rate still relatively low. I think still at levels that we haven't seen since 2017. That non-revolving credit is definitely where we're going to have to keep a close eye on because we are seeing upward pressures from, of course, student loans are going to start kicking back in. Housing moratorium is about to happen, but we're also seeing that mortgage rates are increasing after we've seen this housing craziness and a few other factors coming into play for those non-revolving credit rates. But overall, consumers still in a very good place.
Yeah, so they the revolving credit, the credit card stuff is kind of like your repository of available money that you can spend outside of your income, and of course all the mortgages and the stuff that's hard coded into your daily or your month-to-month expenditures are coming back online, so that's going to have a little bit of an impact on what we see here. Now, the interesting thing to me about the consumer expenditure durable goods is that we saw the van volumes really jump up and take off. And we've got some scaling stuff going on here on the chart, but we see that the van volumes really took off in front of a lot of these expenditures. And
exactly.
I think we probably can tell that freight does have a little bit of a leading indication here, but I think we are also seeing a little push and pull, are we not? Like there's a little bit of leading, but there's also a little bit of backlog in play right now that's going to cloud the future, right?
Exactly, and so there's that leading indicator because, of course, before it can be purchased and these durable goods can be in those consumers' hands, they have to get shipped, of course, and so that's definitely that leading indicator view that we have here, and of course, price is still very much playing a role. I mean, we look at prices, we're still seeing that upward inflationary pressures that have hit levels not seen, I think, well over 13 years, or just around 13 years, and so that's also going to come into play here with consumer spending. In our next chart, we have to look at Upstream and what's going on, and so what we have here, a data set that just got updated this morning around 35 minutes ago. We're seeing in the blue line, of course, we have our ISM PMI, so the Institute for Supply Management Purchasing Managers Index here in the blue line. And in the orange line here, we have our very own flatbed outbound tender rejection index. And so we saw this easing in the flatbed outbound tender rejection. I say easing very lightly because it's still at 22.9%, so just at 23%. So we see a slight easing there. But what we can tell, or what we can kind of estimate what were to happen within the ISM is that there's going to be an easing as well. And Zach, that's exactly what we saw, was an easing in the ISM PMI that just got updated not too long ago. But the big thing is that it's still well above 50. So 50 being that growth threshold, anything above 50 meaning expansion within manufacturing, anything below 50 being contraction within manufacturing. So in the latest month, we saw a reading of 59.5. So that's a downward movement of 1.1 percentage points. The other big trend that we have to look at, of course, is going to be prices. I mean, that just hit a high that we haven't seen since 1979. That eased down once more to 85.7, which is a 6.4 percentage point drop, but still very much elevated. So remember, anything above 50 expansion, 80s is still very much high. So even though these are starting to come down, that doesn't mean that it's stopping or declining. It just means that it's still growing, but just at a little bit more of a declined rate.
We always have to be careful when we're talking about things kind of easing or loosening.
Yeah.
We got to put it in perspective in the appropriate context. Good stuff. Anthony Smith,